To shareholders, I assume, not customers.
Oh, sorry.
Yeah,
They
to
paid out nearly
shareholders. Yeah.
20% of the market cap last year to shareholders,
Mhm.
and they've got nearly half the market cap in cash. So for me, I just have to give up now. I have to say they've proven it. They've proven they can do it.
Could you get over these things and go for this one, Roland? Because obviously the dividend yield isn't huge, but if you include the buyback, the kind of shareholder yield is pretty impressive.
Yeah, I think the dividend used to be more generous, but they seem to be spending a greater proportion on buybacks now than maybe they used to.
Hello and welcome to the Investors Round Table, a three-way discussion where Roland Head, Graham Neary, and myself, Mark Simpson, talk about shares, portfolios, and the markets. Roland likes reliable dividends. Graham likes quality compounders, while I look for deep value. This time we discuss some topical news from Hargreaves Lansdown, plus financial banking group Close Brothers, Jet2, and trading platform Plus500. Let's get started. So Hargreaves Lansdown, that's had results today. So Graham, what do you think about these results?
Yeah, thanks for the question and nice to see you again, Mark. I'm a holder of these shares and I was a little bit disappointed. I think it's quite reasonable for the market to sell off a bit. I spent quite a lot of time going through the adjustments to the numbers. They had adjustments of well over 35 million, nearly 40 million pounds worth of adjustments compared to 14 million pounds last year. And that sort of makes the difference between whether the company's profits are growing or falling. So if you're willing to look past all of those adjustments, then profits were up 5%.
I think just reading the headlines, single digits, it wasn't amazing, but it wasn't terrible. But it's only when you got into those adjustments that you started to worry a little bit.
They've got these strategic investment costs. And I suppose one of the things I noticed, which seems important, is that they have a new chief strategy officer who was a strategy consultant at Boston Consulting Group. Investors often are skeptical about the role of consultants in business, and I think there are some pretty good reasons for that. In this case, we've got a new CEO who, in my opinion, should be running the strategy and be taking responsibility for strategy. But they also have a new chief strategy officer who I assume is responsible for directing a great deal of the strategic investment cost. Along with that very heavy spending, there's impairments which relates to previous ideas that they were working on, which they've abandoned. I don't think I'd focus so much on it if they simply categorized all of this spending as ordinary spending, but it's the way they break it out and say that these are special costs. And then you look in and say, what are they actually spending on? And it says things like improving our help desk client efficiency, service transformation, things that sound like ordinary spending in business.
There's nothing special about those, is there? That should be the bread and butter of this type of business.
Yeah. So look, I could go on, but I'll throw it open. What did you think?
Yeah, same as you really. It's only when I started to get those adjustments that I think that things didn't look as rosy as the headlines. I still think it's an interesting play. I think you're a bit more of a kind of long-term holder on this one. I think this is ripe for a short squeeze. You've got a lot of quant funds, half discretionary fund, and I think I calculated they're probably about 20 days trading, average trading volume short. So that's basically a calendar month's worth of total volume, average volume in the stock short. And this is only people who've declared more than 0.5%. For those who don't know, the FCA regulations say that if a fund is more than 0.5% short of a company, they have to declare it. And a very helpful hedge fund called Castellian Capital has got a nice website called shorttracker.co.uk, which you can go and just see a summary of the data. Yeah, there's about kind of 7% of this company sold short. And I get the fact that the management aren't that good, the strategy, you've got these kind of things, but it's still a very profitable business considering this is really a downturn for retail trading. And yeah, I wonder whether the shorts at some point are going to regret having sold so much volume, and this could be ripe for a squeeze. Roland, what do you think? Have you looked at this at all?
Yeah, I think I am pretty much on the same page, really. I think from a short-term view, there's maybe some weakness in management and strategy. It seems to have a reputation of being one of the more expensive providers of this kind of service, although I think how much that affects you as an investor depends hugely on how you invest, what you buy, how often you trade. But looking at the big picture, it's got about a 40% share of the UK market, I think, from memory. It's hugely profitable. It still generates a lot of cash. And if the problems with the strategy, or maybe the weaknesses perhaps in the strategy and the execution, can be ironed out, then I think fundamentally it looks like a good, cheap, market leading business. And I've always had the view really that if Hargreaves loses its position, it's going to be through its own mistakes, really, more than anything else. The market share they have is theirs to keep and theirs to build on. And I think on balance, I think that it probably will be able to do better again in the future. And I think also Peter Hargreaves still owns nearly 20% of the shares. It's still quite a vocal influence, especially over the last year or so. I suspect he'll be keen to see the business get back to the kind of efficient and effective reputation it used to have. So yeah, I think the results that were maybe a bit disappointing, and like you say, some of the adjustments are not really exceptional items, I wouldn't have said. But on the bigger picture view, I think it's cheap and probably still a good business. I'd be quite happy holding it.
They're not alone in being a business that excludes what did I look at the other day? I was talking Alumask, and it's a decent company, but it's the significant restructuring costs seem to go as non-underlying almost every year, and can name quite a few other kind of small cap companies that will do this. So I don't think it's alone in doing this, and we have to make our own adjustments as shareholders. But it doesn't seem a reason to be really quite negative to me, or quite as negative as the market has displayed this one.
And in the meantime, it's probably worth saying there's a dividend yield over 5%, which still looks fairly safe to me. So that's another attraction for me anyway, in terms of holding the stock, although I don't have a position, I should say.
And something the shorts have to fund as well. They've got to fund the borrow and that dividend. Unless we're missing something and something is going to hit them and everything's going to go wrong, then yeah, I don't see this as an obvious short. I wonder whether that's some buying pressure there in the near future.
So I think I can explain the short thesis a little bit here. If you look at where Hargreaves' revenue was coming from over the last 6 months, they've actually generated more revenue from cash than from funds or from shares. And that's despite the cash balance being held by customers being only a fraction of those other two asset classes. So the FCA, as you probably know, been researching this topic, and Jarvis Securities in the spotlight currently. That's another one we may have discussed before, JIM. But Hargreaves does pass on quite a lot of interest to customers, charges on quite attractive competitive rates, but it also gets to earn quite a lot of revenue from this source as well. So I think the hedge funds who are shorting the stock are probably speculating that the FCA is going to maybe even ban this or clamp down on it in some very restrictive way, which would take out the main revenue stream of the company as things currently stand.
They talk quite a bit about their active saver products, and I wonder whether they're trying to get in ahead of that kind of trend to say, no, actually, everybody has the option to have this active saver product, and therefore we meet our fiduciary duties towards customers in this way.
Yeah, I think in the results, they say they retained 41% of interest during the half year, and they expect this to fall to 36% in the third quarter. Depending on how you look at it, they're passing on the majority, but they're also keeping a healthy slice of it. I don't think they're that unusual among the other big brokers as well, but the trend is probably towards passing on interest a bit more transparently. But my guess is that the current levels of cash probably won't stay that high anyway, and people will either withdraw cash altogether or start to reinvest it, hopefully, over time. But I think the active savings are a much lower margin for Hargreaves. So people taking that up would be good, maybe in some respects, but not necessarily supportive of the overall margin.
As a shareholder, you want enough take up that it reduces the headlines, but not so many that it reduces the profits.
I suppose the other thing people talk about as a risk to Hargreaves looking ahead medium term is that younger investors, or so we're told, prefer a lot some of these newer platforms that are mostly app-based and very free, very cheap to use. And Hargreaves obviously is at the opposite end of that spectrum. I want a full service platform that offers me the whole market of shares and so on. But my suspicion is that if people become more interested in investing and more sophisticated, they will also want a richer, kind of broader platform than some of these apps seem to provide. But it's maybe a consideration for the future and just another sign, really, that Hargreaves has perhaps underinvested in its technology proposition, and it needs to keep on working on its market positioning to recruit new generations of customers, because a wealthy 50 plus customer base that's probably its core, I suppose, will go into withdrawal mode at some point and maybe stop accumulating so much. It's hard to be sure. I
Surely
think,
there's
but
no shortage of retiring dentists and surgeons. I think that's a joke, but also a point that I think it doesn't take very many wealthy clients who are a little bit more elderly than a load of very app-focused investors who are not actually putting that much money into the markets. Yeah, I'd be interesting to see the trends on this over the next few years. Should we leave that one there? And that's the kind of topical news one. And I think staying on financials, Graham, you're going to introduce a spread betting company to us.
Yeah, sure. So Plus500 with the ticker Plus released results this week. This is one that I've been very skeptical on the past. I've even been known to battle with its PR companies from time to time over their risk management practices and policies. I generally was skeptical of Plus because they didn't seem to hedge their risk in the same way that others in the market do. So I'm a long-term shareholder in IG Group, and my understanding is that IG doesn't really face much market risk at all. It's hedged the vast majority of it away. Plus500 seems to be a bit more, in my opinion, it seems to be a bit more relaxed about market risk and has accepted exposure to market movements. But its results speak for itself, and it's got an enormous cash balance, for I would say probably quite a lot more than it needs. But the cash balance has been used, I think, as a kind of a buffer in a way that they're saying we're not hedging maybe as much as our rivals do, but if things go the wrong way, we can afford to take some hits. And I'm sure they do try and minimize any hits that they do take from the market. So their 2023 results, they weren't great in the sense that revenues were down 13%, adjusted or EBITDA was down 25%. It's still enormously profitable, and they've announced $175 million going to shareholders in the form of a buyback and dividends. It's not as much as they did last year, but it's still a pretty big number, considering that the market cap is $1.9 billion or so. To be sending nearly 10% of that to shareholders in a bad year, I would say, is pretty remarkable. It's headquartered in Israel, but it is an international company with operations in many different countries now. It's grown to a very impressive scale. It's quite ambitious in the United States, which I think is quite interesting. And yeah, overall, I've come around to this one. I think customer churn is always going to be a concern. I still find it difficult to believe that the quality of their customer in terms of the sophistication of the trader on Plus500 is anything close to IG or CMC. And some calculations there, which I put up on Stockopedia, which suggested to me that customers might be sticking around for 2 years possibly, or that they lose half of their active customers every year. So there is an ongoing marketing effort. There is that risk that they might struggle to recruit new customers in any given year.
Yeah, I've been wrong on Plus500 for quite a few years. I haven't actually shorted it, thankfully, given some of the performance, but I always viewed it as the company that seems to be betting against its customers. There's a lot to talk about hedging and things like that. And the idea that IG, if you go long a certain company, they'll typically buy the shares. So they don't really care in aggregate whether you win or lose. CMCX do a sort of dynamic hedging and sit some. You might think the simplistic ones is they try and hedge the good clients and not the bad clients, but I think it's a bit more sophisticated than that. And there's probably some trend following and lots of things there. And they've been pretty successful with that. And my simplistic view of Plus500 has always been that they just don't hedge at all. They just try and attract clients who are going to lose and then don't hedge. And I've always thought, oh, they're going to run out of clients. There's not enough people in the world who are going to get a spread bet account, put a lot of money in, have highly leveraged positions that get stopped out, and effectively give all their money to Plus500. But there's no sign of slowing down so far. So, Graham, do you think that there is the market that they can keep growing? What's the figures on that, or feel for what their scale is in, obviously, of more unsophisticated investors, perhaps?
I think there's a phrase you've probably heard before, Mark, that says, a sucker is born every minute. And I'm inclined to think that there's a constant flow of these traders who mature to adulthood every year and open a Plus500 account. Now, I don't want to be too rude about Plus500 customers because I'm sure they do have some winning customers. I'm sure it says on their website what percentage are winning and or losing. They must have some winning customers. But I do believe that it's a lower quality of customer than the others. But I just think that after so many years, personally, this is my way of admitting defeat as a long-term bear of this company. I'm admitting defeat now because in a bad year, they're paying out 10% of their market cap in cash to customers. Last year, they paid out nearly 20% of their current market cap to customers. They've got nearly half their market cap in cash.
To shareholders, I assume, not customers on that one.
Oh, sorry.
Yeah,
They
to
paid out nearly
shareholders. Yeah.
20% of the market cap last year to shareholders.
Mhm.
They've got nearly half the market cap in cash. So for me, I have to give up now. I have to say they've proven it. They've proven they can do it, and I give up.
Could you get over these things and go for this one, Roland? Because obviously the dividend yield isn't huge, but if you include the buyback, the kind of shareholder yield is pretty impressive.
Yeah, the dividend, I think the dividend used to be more generous, but they seem to be spending a greater proportion on buybacks now than maybe they used to. But I should say as well that, like Graham, I'm also a shareholder in IG Group. So for me, the proposition is I've always had the same sorts of concerns about the quality of Plus500's customer base, and talking about the percentage that win and lose. In the UK, all the CFD providers have a percentage, a banner on the top of their websites telling you about how many customers win and lose. And I just had a look, and Plus500 say 81% of their customers lose money trading CFDs with them. And on IG's website, it says 69%. So I'm not sure that's all that conclusive, but
It's
I
definitely
think,
higher, but it's not. Yeah.
yeah,
I
I
am
mean,
being a little bit facetious describing the entire customer base.
yeah, clearly Plus500 does have a model that has worked and for a lot longer than I think many of us thought when the company first appeared in the UK market. I do wonder about some of their overseas operations as well. They say they have 13 regulatory licenses, but it includes some of the locations, like Graham said, the US, where they've got a futures business that seems to be targeted very much at retail investors, from what I can see, with what seems to be fractional futures contracts to bring down the value, and lots of crypto futures and that sort of thing. And Japan, which is another market, I think, where IG is one of the more important overseas ones for IG as well. But also Plus500 operates in the UAE and the Bahamas. I'm not sure exactly what sort of markets they would have there. I think with this, for me, given that there's always going to be some regulatory risk here and quite a lot of competition and customer churn, for me, it makes sense to invest in the top of the market. And from what I can see, that's IG Group rather than Plus500. And so that's where I've been, that's where I am invested. But really, like Graham, I've reluctantly converted to believing that Plus500 has a sustainable business that is very well run by and large and performs well for shareholders.
Does the Israeli link put you off at all? Is that something that's...
Yeah, it's a consideration. It's more of a consideration maybe than it would have been, in the sense that it's just an unknown risk, really. Some of the Russian stocks a few years ago looked quite good value and appeared to perform quite well, churned out big dividends. But that was another risk that just wasn't really worth taking in the end. I'm not saying that Israel is comparable in any way, but I'm becoming less keen on owning overseas businesses than I might have been once.
Graham, any other risks you perceive within this business? Any black swans, something we haven't considered?
I would just say on the previous point that this is not a random sector in a random foreign country. This is a trading gambling, if you like to call it that, company based in Israel, Israel is known for hosting these types of companies. So it's in that sense, I would have a little bit more comfort with it than a company in somewhere else, Russia, Eastern Europe, in a random industry. This is a familiar type of business, in my opinion, and it is massively international as well, as we know. There's offices all over the place. I think that's worth saying. I also know that they broke out their interest income for the first time in the most recent results. So they had over $50 million of interest income during the year as well, which that's not peanuts given the market cap.
On customer balances, because surely they would have put their interest income on their own cash balances before.
Let me just read it out to you. Their own cash was 900. So is it reasonable that they earned 50 on 900? Yeah, that would make sense that they earned $50 million of interest on their own cash balance of 900. So yeah, that would make sense.
Yeah.
That would be on their own. But yeah, they've just broken it out separately for the first time. And it did make a nice boost to their they presented it as part of revenues now. So yeah, just something else to be aware of, that they can put their own money to work now. And other risks? No, I've discussed the stock for years. I used to call it a bucket shop, which I think was a bit mean, a bit unfair. I think they do take risk management seriously. After so many years in business, if they weren't taking risk management seriously, they'd have had more serious problems by now, I think. I don't think you could be that lucky for so long. And there's lots of things they can do to manage risk, so that are under the hood. But yeah, that's it. I can't think of any other risks.
I think I still view it a bit like a casino, but then there's also a saying that nobody ever lost money owning a casino. And if you pays to be the house effectively, doesn't it, with these sort of things? I think there is a counterpoint to that, and that's Donald Trump, I believe, lost money owning a casino. But in general, the principle is there. I think if you get your risk management, then it's a profitable business. I'm not sure I can quite get comfortable owning it personally, but yeah. It's probably to my financial detriment over the long term. Roland, any final thoughts? Are you going to jump in on the back of this, or?
I don't think I've got much to add. I was just looking at the numbers, and one of the other interesting metrics the Plus500 reports is called customer trading performance, which is the gains or the losses that they make on their customers' positions. So this goes back to what we were saying about hedging. And last year, the customer trading performance was 74 million. And that's actually a big reduction from the previous year when it was $193 million. This is probably one of the main reasons for the drop in revenue last year. The change in customer income, which is fees and spreads, I think, was much smaller than the change in this customer trading performance figure. To an extent, their results do still seem to be driven a bit by losses on customer trades, although they've always said they expect the contribution from customer trading performance to be neutral, broadly neutral over time. But if that was true and they had a really bad year, then it could really take a big chunk out of the group's revenue. But no, I think there is inevitably a bit of an overlap between these trading firms and gambling. I think it's probably fair to say, in terms of the customer base and the way they're marketed and the way they're used in any case. But it's a legitimate business. It's, as Graham says, it's scaled up, it's international, it's regulated in quite a number of respected markets. It is what it is, really.
All right, should we move on to the one you want to discuss today as well, then, Roland?
Yeah, so this is Jet2, so quite a different business, and I'm sure familiar to many listeners and probably to some of us. It's a known business. It operates a short-haul airline and a package holiday business serving the UK market. And what I didn't actually realize is it's now the UK's largest package holiday operator and the third largest airline in the UK. So it does have a big market share. And just to give an idea, it operates from 11 airports in the UK to 65 destinations in Europe. And the location of its UK bases mean that 75% of the population live within 90 minutes of of an airport that's served by Jet2. So it's very much a mass market kind of proposition, and it's been very carefully developed over the years, in my opinion. And the financial year ends on the 31st of March, and those results won't be due till July. But there was an update recently talking about trading through the winter season and the summer season that's ahead. And they said that they've seen strong bookings through the winter with an increasing proportion of higher margin package bookings. And that's given them enough of a lift to upgrade profit guidance
for the year. And they're now expecting an underlying pre-tax profit of between 510 and 525 million for the current year. To put that in context, last year was 391 million. So that's about 30% profit growth compared to last year. So quite a strong result. And looking ahead to the summer, they're also very bullish. They say that the capacity they've got on sale is 12.5% higher than last year. But despite that, forward bookings are giving load factors, which so how full the aircraft are, they're giving load factors slightly ahead of the same point as last year. So people still seem to be booking holidays. They still seem they're willing to pay a bit more to reflect inflation and so on. And Jet2 still seems to be very well positioned to benefit from this. So in terms of the investment proposition, airlines have always been seen as a bit of a risky bet, very cyclical, and I wouldn't generally look at investing in an airline, or at least not with any degree of kind of seriousness. But Jet2's airline business has been going for over 20 years now and stayed out of trouble and financially and continue to grow. And then more recently, the package holiday business, I think, has really become a big part of the story and is maybe providing a bit more stability and supporting higher margins. Package holidays, I think, was 71% of revenue in the first half of the current year compared to 66% a year earlier. So it's really becoming a big part of Jet2's business. And as I say, they're bigger than TUI in the UK, considerably bigger than EasyJet, which is also building up a holiday business, although that's growing quite quickly. So it could become maybe more of a competitor with a similar brand and similar advantages in terms of its footprint in the UK. But Jet2 seems to have a good reputation. I've been a customer. I've been favorably impressed. The service is exactly what you want and what you expect. The modern aircraft fleet, the staff are good. And they've actually gone backwards a bit in airline terms and become a bit more vertically integrated at the airports where they operate. So they've started taking things like ground handling in-house, which is something that's long been outsourced by, I think, a lot of airlines. And they seem to have a good reputation for service and for not cancelling as many flights as some others either. It's never going to escape cyclical risks and the other general risks that airlines have in terms of kind of a big fixed cost base and so on. But the interim results they showed over the net cash of over 700 million, and that's their own net cash, excluding customer deposits. Return on equity is running at about 30%. Margins are quite good for a business of this type. I think in terms of profitability, it's only really Ryanair that maybe is comparable from the UK listed airlines or airlines in our kind of universe. Profit margins are higher than they were in 2019, and profits are running, I think, at about twice the level too, although there was some dilution with shares and equity raised during the pandemic. So looking at the picture, the recent guidance, I don't think the shares look expensive. The free cash flow yield is running at about 20%. They're on a PE of 8. Although the long-time kind of founder, leader of the business, Philip Meeson, who turned it into what it is, he's stepped down recently. He's still a major shareholder, and I guess that I would hope his influence will continue to be a positive one on the business. So I think it's one of those good businesses that's well run that could just continue to grow for a bit longer than you might expect because it's just good at what it does and a good example of what that kind of business can be.
Graham, is this something you'd consider? Obviously, it's not. A lot of people have reservations about airlines, but on the surface, the numbers look quite good here.
Yeah, thanks, Roland, for the description. It's not one that I really look at very much, but I respect the numbers. I respect the return on equity. Just looking at some previous metrics suggests that return on capital was quite a bit lower than return on equity. So they must run a reasonably lean balance sheet in order to do that. I see that they have a convertible bond outstanding, nearly £400 million, and that converts at just below £18 a share. So there could be some dilution there. I guess 10% dilution from that bond potentially if the share price was to go from £14 to £18 plus. I think this one for me is not something I'd really want to invest in unless I had a strong view on discretionary spending. And for me, it's a cyclical stock. It's the sort of thing you bet on when you believe there's going to be an economic recovery, when you're bullish. I was looking at this note from Canaccord Genuity, and they're talking about house prices and so on. So if you're bullish on house prices and on the cost of living, crisis and all that, if you're positive on all that stuff, then yeah, this makes sense as a recovery play. Long term, I don't really understand how it would generate return on equity of 30% long term. For me, airlines struggle to do that. And I'd really need a proper, comprehensive explanation of how it's possible to do that in the airline business. So, yeah, that's all I'd say on that.
In terms of the bond and the return on capital employed versus the return on equity, there is inevitably some kind of leverage in there. In addition to the bond you mentioned, there are lease liabilities on aircraft and on other assets as well. Although the cash position is, I believe it is strong, and it certainly appears strong at the moment, there are longer term or medium term liabilities in there. But I guess it's probably fair to say that profitability and at the moment is maybe slightly above what the medium term trend is going to be. But I think if the underlying volume growth, or if the business can continue to scale in the meantime, then that's not necessarily a big concern for me. I don't know about you, Mark. Is there something you spotted when it was a bit more unloved a while ago or during
Yeah,
the pandemic?
it's one that I thought was bonkers in the pandemic. I remember them raising money, and they put their worst case scenario, I think, was that the pandemic and everything would all be over by the start of 2021. And of course, we were still having lockdowns, and don't want to bring back bad memories for listeners of that time, but it just was one of those where the price recovered so quickly with the view to everything was opening up again, and it really didn't. So I think there's a bit of a hangover from that. The share price hasn't really gone anywhere since 2021, and it's partly just because it recovered too quickly and then it sold off again with the weaknesses in the markets in 2022. So at some level, it is a sort of super geared, almost exposure to the general market. But in terms of pure wanting to get a bargain, I look at it and there's been a slight upgrade in forecasts. I think the forecasts have gone from 168p of EPS to 171. So it's a it's an upgrade, but it's a fairly minor upgrade. But the shares appreciated about sort of 40%. I wonder whether it's towards the upper level of its kind of current trading range. Yeah, because it's always looked cheap, and it looked quite a lot cheaper at the end of last year. It'd be one I'd be tempted to trade, I think, rather than own long term, for the reasons that Graham said. It's a cyclical business, and it's done well, but it can't necessarily escape the concerns we all have over cost of living crisis. And the dividend yield isn't particularly impressive as well. I think that they're clearly reinvesting that cash and they're going for growth, but they're also sitting on a lot of cash. Yeah,
Quite a big chunk of the cash is customer deposits.
it's 700 million of their own
net cash.
Yeah,
That's how
yeah.
they calculate. Yeah, and that's so gross cash was 3.2 billion, and I think around a billion, just maybe 1.1 billion of that was customer deposits at the end of the half year. Although, of course, I guess they're earning interest on all of that. So holding those sorts of customer deposits is a bit more attractive, maybe, than it used to be. But yeah, no, it's one of those businesses.
Assuming they've got their pricing model correct, because obviously
Yeah.
they're taking the cash and then they're agreeing to provide a holiday in 6 to 9 months' time. And you might own 5% on the cash, but if you're paying your hotel workers 15% more, that there is the other risk of inflation on that side, isn't there?
Yeah, there's a lot of moving parts within the business, and how much of it is hedged and protected is a risk one way or another.
Yeah.
But,
I just feel like if you think that kind of 180, 170 level of EPS is really sustainable going forwards, would you not pay more than kind of 12 or 13p EPS out as dividends? Yeah.
it's not really a stock I'd look at as an income share specifically, but reinvesting the cash and keeping a stronger balance sheet seems to make sense, I think, in a business like this. I suppose if the growth rate slows, then the kind of history suggests that would be the right time to increase the distributions, really, probably, rather than if they still believe that there's opportunities to invest in expanding their fleet and so on and so forth.
Yeah, good point. If those sort of returns on capital, returns on equity are sustainable, then you want them to be reinvesting it. I just wonder whether it's a sign that they know that level isn't sustainable in the sort of medium term. But yeah,
Yeah,
it
that's a fair point. Yeah.
could still be a
Although,
cheap stock.
yeah, no, I agree. I take your point there. I think when I see a really low payout ratio, like you say, sometimes you think it's a sign that's where the valuation might be in the longer term, where it might not just about reinvesting, but also about maintaining sustainable level of payout in all weathers.
Yeah, I would say the growth outlook is not particularly exciting. Just again, going back to Canaccord Genuity's forecasts, it looks like adjusted PBT is not really forecast to go anywhere in FY March 2025 and then grow less than 20% in FY March 2020. It seems to me that the recent growth is still the post-COVID recovery. So 2022 was still very bad, and then 2023 is is a fully fledged recovery. And now FY March 2024 is still we still haven't got like what I would call a normal growth rate. And yeah, I would just be a little bit concerned.
Does Canaccord still have the high sales growth that's because Stockopy is showing it's sort of about 6.3 billion up to 7.1 billion, but as you say, flat profitability.
Yeah, so they've got sales going from 6.3 billion FY March 2024 up to 7.3 billion almost in FY March 2025. But then I guess rising costs, Jet2 themselves were saying hotel accommodation and the EU carbon emissions trading scheme are having an impact on costs going forward. Just going back to what you said earlier, I'd be very surprised if they hadn't fixed their prices now for hotels in summer 2024. I'd be very surprised if they were exposed to that risk, although I could be wrong.
So you think they'll do a deal with hotels to fix a price for future?
For this summer, I would
Yeah,
say
for summer. Yeah.
For this summer, I would say
Yeah.
it's fixed. Obviously, hotel prices have been rising and there's no getting away from it in the long term. So yeah, looking ahead, the adjusted PBT forecasts are pretty flat. Now, Canaccord do think that Jet2 is extremely cheap. If it's not really growing adjusted PBT, maybe a high single digit or low double digit earnings multiple makes sense. If it's at 8 times now, what's fair value? 10, 11, maybe?
Yeah, so it sounds like there's a potentially bit of extra upside, but it requires that kind of bottom line to start growing again before there's going to be any significant returns from this. It comes down to how much you believe the kind of 2027, 28, where we'll see an low inflation, cyclical upswing, and suddenly it could look very cheap again at that point. But there's a fair bit of faith in there, or faith required to believe that's going to happen.
There's always an element of faith required in when you're looking ahead with anything really. Things don't always turn out the way you expect. But in this case, yeah, supposedly we're in a technical recession, in a recession. Obviously, the cost of living pressure is quite real for a lot of Jet2's demographic. There's a bit of a faith required, but I think what attracts me particularly is partly just the track record of generally very good execution, I think, in the sector where they operate. And so while we've seen some of these companies go badly wrong in the past, Jet2 has grown through those periods and profited from the demise of weaker competitors and maintained its own discipline, or at least as far as I can see. So it's maybe best in class kind of business, perhaps, even though it's not going to be immune from the risks that you've been talking about.
On the surface, it's similarly rated to EasyJet, Ryanair, they're all somewhere between a 6 and a 9 PE. But I don't think they hold as much of their own cash as Jet2 as well, do they? So it's, again, the whole sector is going to be cheaply rated for the foreseeable future. So if they can grow, they'll do well. If they can't. Shall I take you quickly through what I thought was interesting? So it's Close Brothers. So this is a bank. And I'm not generally a kind of banking analyst. I'm certainly not generally an investor in banks, but this kind of caught my eye as a bit of a recovery play. Now, when we first talked about putting this show together, then got to say it was about £3 was the price here, and it's currently up about 15%. So it's about kind of 3.45 as recording. So that's some of the value there has recovered, but I still think this is an interesting one that may have a bit further to go. And what do? They're a sort of challenger bank. They're fairly regarded in the banking sector as pretty conservatively run, unique business. However, and they have a mix of businesses who've got asset management as well as typical banking. but it's the banking division that's caused them problems. And that's with the FCA's review into car financing. So typically they've been a big provider of car financing, and the FCA is looking into commissions paid on car financing. And it's hard to work out exactly what's going on. The FCA hasn't provided any actual real guidance, but the feeling is that it's probably going to come down on the finance providers rather than the dealerships and the providers themselves, or the people who've sold the policies for dealerships will have been acting on behalf of the finance companies. So it's likely the finance companies end up carrying the buck on this one. And Close Brothers share price has been weak since this announcement. So you can see just looking at the graph here, at the start of the year, it was hovering around the £8 level. And as the FCA information started to build, then, you see it by the end of January, it was down towards about kind of £5 or £6. And most recently it hit a low of about £3. But you work out what that means really is you've taken about sort of 700 million off the market cap as a sort of rough estimate, peak to trough. And it seems unlikely that the fines will be as significant as that, or the cost to Close Brothers. It's unlikely to put it in financial stress, I think, as well, or significant financial stress, because it's pretty profitable just as a core business. So they kind of latest trading statement said that our business continues to perform well. Banking division had strong margins, stable credit performance, generated 112 billion of operating profit for 6 months. The asset management had annualized inflows of 9%. They own Winterfloods, which is one of the biggest market makers around, particularly for small cap companies. But the thing that caused the biggest, or the kind of the final recent drop, was this trading statement said that they're going to cut the dividend. They're going to not pay any dividends on its ordinary shares for the current financial year, and they will reinstate, because they're reinstating dividends when the FCA review is concluded. So I think this is potentially a special situation where people have sold this stock, or certainly at the bottom, people have sold because of the surprise dividend cut, not because the outlook for the business has suddenly got significantly worse. And it was about sort of £4. So, and I guess this, whether you're ever going to be into banking or not, I think this is an interesting kind of thing of what do you do when a business cuts its dividends. So Roland, have you got rules you apply for this, or you take it one step at a time?
Yeah, I suppose I should start by saying that I am a shareholder in Close Brothers, and obviously the way things have gone, if you'd asked me a couple of months ago, or looking late last year, I thought the problems they'd had with one subsidiary seemed to be out of the way, and I thought they looked good value. As you say, trading seemed to be stable. Their net interest margin for their banking business is much higher than the big high street banks. It's usually around 7%. It's a business that's been in business since the 19th century. The dividend, until the pandemic, the dividend hadn't been cut for about 30 years. This has come as a big surprise, I think, and perhaps because the company hasn't been all that forthcoming about what they think of this situation. They've just cancelled the dividend and basically said they're going to fortify the balance sheet as much as possible. It's created a lot of uncertainty. Yeah, one point that's probably worth making is that whereas, say, businesses like Lloyd's, I think, is a lot of reports have suggested Lloyd's might have the biggest absolute exposure to this motor finance review, but motor finance is a much smaller part of Lloyd's loan book than it is for Close Brothers, where motor finance, I think, is something like 20% of their loan book. So proportionately, the impact could be quite big here. In terms of what happens when a dividend stock that I hold for dividends stops paying dividends, I don't have a hard and fast rule. I suppose I will look at it case by case, but my inclination at least is to consider whether I still want to hold it, because if I think that the capacity to pay dividends has changed, then it may not make any sense. So it may not make sense as part of a consistent strategy anymore. In this case, I am still holding the shares at the moment. I'm not at all sure that I'm going to continue doing so, but it's just been, I don't tend to leap into action all that quickly with these situations. I think I generally let things unfold and try and get something tangible to base a decision on. And with this, I think Lloyd's results are out today, and they've made a statement. They've made a provision, I think, of about 450 million initially for this review, whereas Close Brothers took the opposite approach of saying that it's too soon to have any idea what the impact will be. So they haven't made a provision, which is within the accounting rules, but it does give the uncertainty is a concern. And whether they have an idea they don't want to share or whether they have no idea at all, both of those things don't seem all that encouraging. It's been a surprise, really, for this business, which I thought always had a reputation for being a niche lender with a good ability to price risk and a long track record in these sectors. Yeah,
It's interesting that, Lloyds have taken, what you say, 450
I
million
think so from memory,
something hit like that, because like you say, if they're the biggest overall, they have the biggest exposure, but not as percentage of their thing, you would expect that Close Brothers the provision they potentially will take should be a lower number. And therefore the kind of drop in market cap in response does seem too high. But as you say, the market just doesn't like uncertainty, do they? And they don't like the surprise of this. So Graham, what do you think? Have you been following this situation at all?
Yeah, I studied the recent announcement and I was quite shocked. I think the market cap from memory fell by £150 million on that day of the announcement. And if you ask some people, they will say that dividends don't make a difference to shareholder wealth, whether or not they're paid. You either own the cash in the business or you own it in your own hand, but either way you own it. But I would say it was irrational, but maybe I just didn't understand the negative reaction to the statement. I thought it was quite a sensible thing to hoard cash and turn the balance sheet into more of a fortress. They said on that day that they would make an adjusted operating profit of over £90 million in the most recent 6-month period. With a reasonable conversion into cash of those operating profits, you would hope and expect that they would be able to meet any reasonable fine that might be levied against them. I think their tangible book value is £1.3 billion.
Do you think it will be a fine, or do you think it's like going to be like PPI, where it's going to be an ongoing hit to their P&L over the next 5 or 10 years?
They themselves are saying that they have no idea. I would presume that there's a good chance that there would be compensation and penalties. And it is very difficult to say how much that could be. But for a company whose total revenues annually are about £1 billion, what sort of fine makes sense on one arm of the business, paying perhaps some more commission to brokers than is deemed reasonable? I don't know. It's hard to come up with a number off the top of your head, but I think they can pay it.
Yeah, I think that there's a big difference between a one-off payment that could be a significant fine and the kind of drip of ongoing customer redress, because it's very easy to meet from ongoing profits. The PPI was, I guess the risk is the PPI was far bigger in the end than anybody or all the banks provisioned at the start were what they ended up paying was nowhere near the payment in reality. So it feels like there's a bit of ongoing risk there, but certainly from what we know so far, I think the reaction is it's an overreaction to the share price, and particularly to that dividend being cut. Looking at the shareholder register, there's not obvious a load of income funds, but I do wonder whether it's the kind of the typical asset managers: Aberdeen, BlackRock, Royal London, M&G, Fidelity, Vanguard. So some of those might be tracker funds, that kind of thing, but some are discretionary managers. But I wonder whether they've had this in their income funds, and a lot of them just have to sell. I like a forced seller. That's what I like about dividend cuts. As long as you don't own the stock at the start, anything that has a high dividend and it gets cut, I think it gets oversold by investors and can be an interesting recovery play. That said, if the share price got up to, say, £5 pretty quickly, I think I'd be out. I wouldn't take the long-term risk on this one, but it just feels like an interesting special situation. Do you have a price target where you get out, or are you more led by the news flow?
I suppose I am hoping secretly, perhaps privately, that there will be a little bit of a recovery after the sell-off we've seen. That might not stop me selling, really, because I suppose one of the things that you seem to see with this kind of thing quite often is that it takes much longer to be resolved than anyone ever expects at the start. And Jarvis, I think there's another company that we've talked about before, perhaps. Their FCA engagement relationship, not sure what you'd call it, seems to be carrying on a little bit longer than expected. S&U now are still talking about some work they're doing with the FCA. They're not suggesting any wrongdoing in any of these cases. And then obviously PPI was the ultimate example of something that was much bigger and much longer than anyone expected. So Close Brothers, they've said they're not going to pay a dividend this year. That, from what I can see, that should save about 100 million, which can be then kept on the balance sheet. Like you, really, my suspicion is that this is too cheap and there probably is value here and that they will be able to handle the redress. But that might not be the whole story, I suppose. This could be a disruptive influence on the situation, maybe for longer than we're thinking at the moment. It's a calculated risk to stay in or to stay out, I think, and everyone has to work out what works for them, and when the dividend comes back, it will be maybe a shadow of its former self. I think that's a possibility, a much smaller payout. And the other thing is too, I think the FCA have started talking about premium finance recently, and that's another niche, unfortunately, that Close Brothers operates in, from what I understand. I'm not sure if there's any exposure to the products that are being looked at, but with this much uncertainty, it doesn't make for, it's not something I'd be buying in the hope that the dividend will suddenly come back at full strength, put it that way. I'm looking at it on the assumption it probably won't, at least not for a while.
It does feel like the FCA get their bee and bonnets about certain things, and they allow things to go on for a significant amount of time, and then suddenly it becomes priority number one and they go full force on something. It's the risk of being in a regulated business. Yeah, sorry, I'll go.
As I say, in this case, again, the FCA have said now that they're going to look at these discretionary commission arrangements back to 2007, but they weren't regulated, I think, until 2014, possibly, before they were then banned in 2021. So they seem to be, they've extended the scope back before they actually took over, from what I understand anyway, before they're looking, before they actually regulated the product, they're still going to be looking at what was done. But I know they said in 2019 that they thought these discretionary commission arrangements cost consumers about 300 million a year, more than flat fee models. I think that was what the FCA said back then, and presumably that was what led to the ban in 2021. So whether that's an indication of what the likely redress might be, I think there'll probably be a lot of other costs on top of that, one way or another. But yeah, it's always an uncertainty, and and at the moment there does seem to be several areas the FCA is taking more interest in.
Graham, are you tempted to play special situations like this, or do you tend to stay away from uncertainty in your financials?
Yeah, I have done in the past. I'm not currently doing much special situation stuff anymore, and I don't own this one. I think if you're a fund manager at one of the companies you mentioned on the shareholder register here, you may have built a very sophisticated spreadsheet valuing this business, and the FCA has just put a bomb in your spreadsheet. And the company themselves say we have no idea what the impact is going to be. So I suppose from the professional fund manager perspective, they're holding something that they can't value anymore. And that's why the people say the market hates uncertainty more than anything else. They'd rather just have the bad news and be able to value it, the company, in the light of the bad news, rather than not know what the bad news is. If I was going to have a rant about the FCA, which I have no intention of doing, I would point out that this does seem very retrospective in nature. And I don't know how, maybe you can teach me about the ins and outs of PPI, but I don't really understand how the FCA could penalize the company for doing things which were perfectly compliant at the time. I don't think there's any suggestion that Close Brothers broke any law at the time that the law was in force. Yeah, I don't really get what they're doing.
It builds uncertainty into quite a few, or any regulated business, really, doesn't it? As you have that thing of, if you're trying to attract capital to the UK and to UK companies, then what you need is, yeah, absolutely enforcement against kind of wrongdoing and poor business practices, anything that rips the consumer off. You absolutely want that to be enforced, but you also want clear rules about what that is and a clear understanding of, otherwise almost every regulated business has this sort of black swan cost in there, and it has to be priced. You can't, every business you hold, you have to price the fact that it could have a black swan event that would wipe out its equity and at the whim of a regulator. And weirdly, other regulators don't seem to do this. Things like Ofwat don't seem to suddenly surprise the water companies and say, hey, you've dumped a load of sewage, we're going to make you build better things. They say, oh yeah, build some better things and we'll up everybody's bill by the amount that it costs to do it. Yeah. A slight rant there. I went for a small rant.
I provoked you into it, Mark.
Should we call it a day there? I think we've probably covered enough for one podcast.
Yep.
Well, that's it for this time. Thank you for listening to the Investors Roundtable podcast. Please like and share if you enjoyed this podcast. It does help us out. If you have any questions to Roundtable, please leave them in the comment section below, and we'll do our best to answer them in the next Roundtable podcast. Once again, thank you for listening, and until next time, happy investing and goodbye.